Hi, welcome to this video today, which is all about Forex risk control, money management and placing stop losses correctly in terms of your trading strategy. Now, in terms of most beginners who trade the Forex markets, they don't think closely enough about their money management strategy or stop loss strategy. They're more interested in getting the best entry. Now, I would say that, in terms of Forex trading, your stop loss is as important as your entry. I personally think it's more important. The way you place the stop and the way you manage it to help you obviously get good risk control, but also to stay with big trends. It's a fact that most beginners cannot hold big trends. Now, in terms of stop loss errors and tips on placing stop losses correctly, drawn up some points on a storyboard, which we'll now go and take a look at and discuss in more detail. Right, let's look at some common Forex stop loss mistakes and also some techniques that can enhance your stop loss strategy and help you achieve consistent profits. Now, in terms of point number one, risking too much per trade. I'm sure you're not surprised to hear me say that. Most beginners do. They very often don't even know the risk they're taking. They'll take maybe 10% risk on one trade, or 20, or even 50. And of course, that leads to disaster. Now, I'll come to the way that you do risk per trade in a moment, because it's not as simple as just deciding risk per trade. Okay, a lot of traders, let me explain, will look online and they'll see that the optimum amount to risk that most people say is about 2%. So they think, oh, I could take 2% risk per trade. So they do a trade and then they do several more. And you find many beginners end up with 10 trades in the market, 2%. Well, that's 20% account exposure. They mistakenly think that they've diversified, so not all trades are going to go wrong at once. Trust me, one trade can go wrong, 5 can go wrong, 10 can go wrong at once. You don't see it as just risk per trade. You see it as account risk. It's more important. And I put the 5% rule. Now, the 5% rule is basically this. Your account exposure, if everything goes wrong, is 5%. So you can have one trade of 5% or two of 2.5 each. It doesn't matter. You can have 5 of 1. But 5% is the maximum you should have. Now, I'm not going to go into the mathematics behind it, but that is a good exposure, which gives you good risk control, and you can make a lot of money just having 5% risk. Okay, now in terms of the mathematics, once you get above 10%, then your risk to ruin really goes up. So I'm going to say 5%, certainly for beginners. Okay, if you're doing well, you might want to risk a bit more, but never more than 10%. Okay, so always keep that in mind. It's exposure to risk, not the individual trades. Okay. Now, in terms of point number 2, this is a really common error, using mental stops. Trader places a trade and says, well, I'm going to stop myself out at X level. Well, my sort of question would be, why don't you put a stop in then? If you're going to stop yourself out, why have it mentally? Traders do this because mentally, they don't really want to take the loss. It gets to their stop loss, they'll just keep pushing it back. Never use mental stops. Your emotions get involved. You want to stop in the market. That's where you're wrong. You're out. Mental stops do not work. Also, there are a lot of traders who put stops in the market. Then they want to move them back. So the price creeps down to their stop. It might just come up a little bit. They'll think, I'll just give it a little bit more room. Then the price comes down. They think, I'll give it a bit more room. They keep moving it back. Once you've determined where you're wrong, you get out. Okay? You can always get back in. But using mental stops, moving stops back, no. Stop needs to be in. You need to adhere to it. Now, a really common error is determining the trade size and then the stop distance. So let me explain. What many beginners do is they decide to put on what is relatively, let's say, a big size, but they don't want to risk more than, let's say, 2%. So they put the stop 2% back from the entry. and they end up putting it too close, so they're going to get taken out by the noise. You never determine the trade size first. What you do is you decide your risk per trade. Okay, let's say it's 2%. Then you decide what distance you need to stop, and that will determine your trade size. So let's say you decided that you need to risk 200 pips on a trade. That trade size is going to be 50% of the size compared to one you use a stop loss of 100 pips. So you determine the trade size by the distance to stop, so you can keep your stop far enough away outside of the noise and hopefully run a good profitable trade. Okay. Point number 4, it is a most basic error out in my view. You can always tell beginners or traders who are going to lose longer term when they want to jack up their stop to entry to prevent loss. So it moves a bit in their favour, they move the stop up to entry, and then in their own minds they think, well, yeah, it's a free trade now, so to speak. I'm playing with the market's money is a common phrase you hear once that's done. No, you're not playing with the market's money at all. By moving the stop loss up too quickly, okay, to entry, you're just fearful of a loss. You can't have much confidence in your trade, because if you're confident in the trade, if you put your stop loss too close, you get bumped out by the noise. It could go back the way that you thought, and you'll miss a really great profit. So you're really restricting your profit potential. It's fear of loss that has people moving stop to entry. They don't have confidence in their trade. Otherwise, they wouldn't do it. They keep it a sensible distance back. So always keep that in mind. You are not, engaging in good risk control at all. You're just going to basically make sure that you never make any really big money, okay, from the markets, or get really big trends, because your stop comes up too quickly. It's a huge mistake. Another big mistake, and I've always thought this is pretty dumb as well, is hedging a losing trade with a counter trade. You see a lot of people talking about this online, about how they put a trade in against their loss and they release it later on and the trade becomes profitable. Why not just stop yourself out? It's the same thing, isn't it? If you put a hedge on, all you've done is you've got the loss in the market, okay, just as if you did a stop loss. You've got to take the hedge off. I think hedging, again, is done by people who just don't have confidence in their trading strategy, or just too fearful of losing. Stop yourself out, reevaluate, then come back in. There's no need to hedge against a losing trade. Point number 6, stop behind an obvious level on a chart. If you look at a chart and you see an obvious level of support or resistance to put your stop behind, if it's obvious to you, it's obvious to other retail traders, and it's also obvious to professional traders who make it their business to hunt stops. Okay, so if you're behind an obvious level, you're probably too close. And big institutions make a huge amount of money by pushing prices to obvious levels, catching the stop clusters, then the price rebounds back the other way. So you don't want to be behind the obvious level, go one level back. Okay, and that basically applies to if you're trailing a stop. Try and trail the stop outside of the noise. Okay, don't be tempted to bring it up too close. If necessary, take 50% of your trade off, so you've got money banked if you've got enough, and then you can keep the stop back a bit further on the open trade. Point number 7, I've spoken about it frequently, placing stops on or near round numbers. Round numbers, institutions know that basically retail traders will place their stop, on a round number or near one. So let's say it's 130 British pound resistance. Trader places his stop at 130, or maybe just a few pips back. Institutions know that. Always a lot of order flow around round numbers. They'll drive the price of those round numbers and catch the stops. Now, in terms of a round number, speak about this frequently when I'm doing my analysis videos. I would normally keep the stop back at least 30 pips behind a round number to stay outside of the noise. That's just a general rule of thumb. So be very careful with round numbers. And yeah, also that applies to entries. Don't place an entry right on a round number. Wait till the level has been cleared by 30 pips as a general rule. Point number 8, stop static and not exiting when in doubt. A lot of traders, what they do is they put an entry in, they put their stop in, and they put their target in, and they just wait. Either their target's going to be hit or their stop's going to be hit. Now, in terms of how often does it happen when the price action doesn't really do what you hope it will do and you go into a small loss, you're still not at your stop loss level, but you hold the trade, then it gets closer to the stop loss and then it hits the stop loss. A lot of traders have that feeling, well, yeah, my stop loss is probably going to get hit, but I'll just wait as I put the stop there initially. Don't. Be dynamic. If you're in a small loss and you think your stop loss is going to get hit, just get out the market with a smaller loss. In terms of the points contained in this video, beginners will make one or more or all of the mistakes I've just listed out. You need to avoid them. If you avoid all those mistakes, and yeah, the logic of why you should avoid them I've obviously gone through, that gives you tips on how to enhance your risk management overall on your individual trades and also on your account overall. So that is the video for today. Thanks for watching me. I hope you found it useful and informative. Take care and have a good day.